is a nice little display of defensive management, looking at your shop trade. But of course, we will be taking questions, looking at some trade ideas. Oh, I think that was my close for the Netflix.
There you go.
But yeah, if you want to join us on the Tasty Live YouTube channel, you can throw in your trade ideas, questions along the right-hand side of the chat. We're streaming live there right now. But yeah, let's walk through this and we'll talk about your magic adjustments.
Thank you. It's not magic at all. It's just mechanical. Took a little bit of risk on both sides at points, and just stayed small and was able to manage the position. This is kind of just an example of why staying small is so important, and being able to just manage your positions over a period of time so that you can get back to a scratch or even from a couple $100 loser.
Yeah. I like it.
All right, so you want to start in the front? Yeah, so I started with a 28 strike short put in Shopify this back in October. Stock was trading around 30. Just to give you an idea, right now it's at about 40. It's at 39.32. So it was trading around that range. It might have been an earnings trade. I don't totally remember if it was, but 28 strike put, probably used a couple $100 in buying power. Sold it at $2.25. Just pretty standard position. Very small sort of position. Over the next week or so, the stock goes from 30 to 25. So it goes down about 20%, 15-20% in the course of a week. I'm still short that put that's now in the money, a couple points, $2-3 in the money. I sell that call against it. I collect another $2.18 on that position. And now I've got the 28 straddle. So, taking a little bit of heat on the downside, basically to my break even, maybe a little bit past my break even on the naked put. Means I want to reduce some of the delta, reduce some of the exposure. I sell that call against it. $4.43 in credit. You can see my break evens expanding. I'll now have risk on both sides, but moving those break evens, further out of the money. 1031, we've gotten that 20-30 days of time value out of the position. It's time to roll. I take that position, and the stock's now trading at 34. So we've gone from 30 to 25, now up to almost 35 here. A $10 move to the upside, 30% up move in a pretty quick period of time. So time to roll out. It's the 31st. I take it from the current expiration, roll it out, and then I move to an at the money straddle. So just taking that 28 straddle, which is now slightly short delta, to basically at the money or slightly short delta straddle by moving those strikes up. So you're reducing your delta, you're flattening your delta, getting less short, moving the strikes closer at the money. I do that for basically a net zero. I do it for a 5-cent credit, a nothing credit, but it moves your break even more towards where the stock is trading, right? If I had just my original strikes, I was past my break even to the upside. Rolling out in time, being able to collect added extrinsic value via the time value that you're rolling out allows me to go closer at the money and move and adjust my break-even point so I'm more, centered around where the current stock is trading. Couple weeks go by, 2 weeks here, you get the stock moving back to 40. So now we've gone from 30 down to 25, now up to 40. We're just getting totally whipsawed in either direction. 20-30% move to the upside in pretty short order, about a month and change. I take the put, I roll up the put. I'm a little bit inverted now. This adjustment I do for $1.16. It basically is kind of a white flag adjustment, right? So I've collected $5.65 or 64 cents of credit. I'm rolling up the put, and now I'm $5 inverted. So this trade isn't really one that I can exit for a profit in that expiration, just because even if you get a move in between your strikes, to get the position down to 64 cents of extrinsic value, you'd have to hold it till the last couple days until expiration, and I'm not planning on doing that. So this sort of adjustment was sort of like a white flag. Okay, I'm hoping a little bit of a down move comes. I can roll this out again, continue to collect some extrinsic value, and maybe exit for a scratch or a profit in the future. Of course, the stock continues higher. So you got the stock going to 43 now. So we've gone from 25 to 43. It's almost doubled here in a pretty quick period of time. I take that position, I roll it out, and I adjust the strikes again, just like I did with the original straddle, where I moved from the 28 straddle to the 32 straddle, moving it up a couple points into the rally. I do the same thing here with the 32, 37 inverted strangle. I move that up to the 40, 35 just to reduce some of the delta on the position and kind of center myself around where the stock is trading, collect a little bit more extrinsic value on that position, and just continue with it, but still leaning short, of course. So I did that for 55-cent credit. Again, this position, $5 inverted at $6.19 of credit, means I've only got $1.19 in wiggle room on that position. That's the most that I can make on it. It's not a trade that I was looking to exit for a profit. I wasn't looking for a $50 or $100 profit. It was one of those trades where this stock has just taken me for a ride in both directions. It's time to get bailed out or potentially get bailed out, and that's what that adjustment is. So you get another 20, 30 days of time value off the table. We get to the end of December. The stock's actually come down, so we're now at 35 and change. We're right in the middle of my inverted strangle. I take that position and roll it out in time, but also take off that intrinsic value. So I've been rolling this intrinsic value forward, this $5 of intrinsic value forward for a month or month and a half now. I finally buy that in, and there's going to be a $5 cost to that. The debit is only $2.13, and that means that I'm collecting roughly $2.87 of extrinsic value on that roll. So rolling out in time and reducing that inversion, that $5 inversion takes $5 of risk off the table, but only costs me $2.13 in value at that moment. So it takes off that intrinsic value and gives me an out of the money strangle where I can take advantage of all of the extrinsic value decay. I can finally get into like a position where I can exit the trade for a scratch. And you can see through all these adjustments, I've collected about $4 in net credit, including all the debit rolls, including the inversions and taking off the inversions and rolling up the straddles and adjusting the strikes. Through all that, I've collected about $4 in credit. So then yesterday, we got a nice move lower down to 39 because the stock has been higher. Just to give you an idea, it was trading about 41-ish at the end of last week. Get a little bit of a down move. I take that position. It's the 35.40 strangle. I close it out at $4.20 debit. Of course, I could have held it for another day and got it to exactly a scratch, or maybe I would have it's trading at 4.05 right now, so I would have made a penny on it. But
green scratch.
You would have done that, Mikey.
Oh, absolutely, I would have.
Well, this is a position. Ivy rank is down to 18 now. I've held this for 3-4 months. I've taken this from a couple $100 loser to a scratch. It was a trade that was time to go.
Yeah, that's fair.
So here's a visual of the trade. You can see all the break evens and the strikes, and you can see I'm just rolling with the moves in the stock. I'm not leaning heavily directional in either direction into these moves, but you can see that once I get to a point where the stock is past my break even, that's when I'm doing something with the position. It's that day or shortly after that day. It's not like I'm sitting here and waiting for the stock to go significantly against me and then adjusting. I'm doing them pretty quick and pretty mechanical.
Yeah. So you had the straddle as of right here when you added the short call break even to the upside.
Yeah.
Then you move the straddle up with the stock price going up. Then it breached your break even again. You go inverted to push your break even a little higher, and then you just kind of massage that inversion. And then here you buy the guts, sell the wings, just reversing the inversion when rolling out in time, or removing the inversion, I should say. and bringing this back into a regular strangle. You can see you get a nice break even to each side with the credit received. And even if you didn't close this, if you just had this position on, you could roll out again and boost the break evens again. And this is how all of these charts look when we do these anatomy of trades. It's always the green dotted lines, which is where our break evens are. They're following the stock price roughly, and they're continuing to expand as we collect more extrinsic value. And that is the name of the game, because eventually, as long as the stock doesn't go, down 80%, like a lot of these stocks have, if it stays range bound, you're going to collect enough extrinsic value over time so that to a point where it's going to be very hard for the stock to beat you. And that's the goal with risk on both sides.
Yeah, and 2 points of what Mike was saying about the 80% down move. You can't fight that. But here, even though it's a couple dollars in this underlying, it's still 10, 20, 30% moves to either direction. That's those are big moves, and this is a high volatility product. So you're collecting a lot of extrinsic value. You can afford to take that sort of risk, but it's not the outlier 80% moves. That's the whole point here is, if this would have been a 10% move in either direction, I would have been out of this, for a profit a lot longer, a lot shorter of a time frame. It would have only been a 1 month trade, but you get some realized volatility, but because of that high implied volatility, you can collect some credits. One more point to make is that last adjustment where we widen out, or where that break even widens out there when I flip from the inverted strangle, the 35 call, 40 put. When I take that and I buy in that intrinsic value and roll out in time and roll to the out of the money strangle, even though it's a debit, you can see that the break even widens out. And that's because of that difference in extrinsic versus intrinsic value. So you're inverted $5, but you're only paying $2 and change to take that $5 off the table. That means that the $3 in difference is added value that you're putting on for this new position, is $3 of extrinsic value. And that's why that range widens out. It's because of that difference in intrinsic versus extrinsic value with the rollout in time, even though you're paying a debit to do that.
Yep. And that's why we call it a synthetic credit, because you're paying $2 to remove $5 of intrinsic value. So you have a synthetic credit of $3, and that is visualized here.
Yeah, and if you would have rolled the same strikes, the inverted strangle, which is fine to do, it would have been a $3 credit roll. Mm-hmm. It's the same thing. It's just a cleaner position, in my opinion, to have the out of the money strikes as opposed to having a $5 inverted position.
Yeah, and it's cleaner to look at, but it's also, you're going to have better markets. You're going to have more narrow bid-ask spreads, because now you're moving to out of the money strikes, which have narrow bid-ask spreads, generally speaking, relative to in the money strikes. So it's just a better adjustment than keeping it inverted. If you can make the adjustment and you can see that you're going to get a nice liquidity bonus for doing it, there's no reason not to if you're doing that.
Yeah.
Beautiful. Great job. Yeah. I'm going to jump immediately to Jay's question, because I think this parlays directly into this segment. So Jay says, Julia's book speaks about core and supplemental positions. Is this something we should be sticking to if we largely stick to premium selling? I haven't been and would like to know if I should be. So I would say if the account size is large enough, then ideally, core position would be something in like an ETF tracking product like SPY or SPX or E-mini futures, whatever. There's a reason why a lot of the rising stars are trading those products. It's because in this particular product, in this example, you saw Shop go from 25 to 43 back down, and you're seeing 20, 30 point swings every week, where in SPY, a really bad year is down 30%. It's just much more easy to manage and manipulate if you're trading a more stable product. So our core positions are going to be in those ETF world products. Our supplemental positions are going to be in products like this, where we're taking on a little more risk, we're taking on a little more volatility, but it's not our core position. It's going to be a smaller position than if I were to be trading like a strangle in SPY.